So break-even point is number B. The first one we talked about impact analysis in the previous class, and we are saying that break-even point sensitivity analysis, which is the second type of sensitivity analysis, you say this ascertains the change in a variable that will push the project to 0 NPV. This ascertain the change in a variable that will push the project to 0 NPV. At break-even point, that is the second paragraph, at break-even point, the NPV is equal to 0. At break-even point, the NPV is equal to 0. Let's take an example. You can call it illustration 1, and say, illustration 1, and say, ABC Limited wants to buy an equipment costing 500,000. ABC Limited wants to buy an equipment costing 500,000. So that is the initial outlay, 500,000. Initial outlay, you know what it means. It has a useful life of 3 years, after which it will be sold as a scrap value for 80,000. So this project has useful life of 3 years, after which it will be sold at a scrap value of 80,000. We are together. It has a useful life of 3 years, after which it will be sold as a scrap value of 80,000, right? For each of the 3 years of the useful life, for each of the 3 years of useful life, of usage or useful life, the equipment is expected, for each of the 3 years of usage, the equipment is expected, for each of the 3 years of usage, the equipment is expected, for each of the 3 years of usage, the equipment is expected to increase both sales revenue and operating cost. The equipment is expected to increase both sales revenue and cost by 600 and 400 respectively. To increase the revenue and cost by 600. So revenue will have 600, but cost should be 400 respectively. So this means that we are saying that for each of these of the years of usage, for each of the years of usage, the equipment is expected to increase the revenue and cost to 600 and 400 respectively. That means it is an annual thing, right? So this one makes it annuity. It is an annual thing because they are saying each year there will be a cost of 600, revenue of 600, and then cost of 400. I'll repeat again that for each of the 3 years of usage, the equipment is expected to increase both sales, revenue, and operating cost by 600 and 400 respectively. Also, the cost of capital is 10% and the tax rate is 30%. So we have cost of capital, which you can say COC, is equal to the cost of capital is given as 10%, and tax is given as 30%. Immediately you see tax, I'll repeat again, that the company's cost of capital is 10% and the tax rate is 30%. I'm just reminding you of what we said yesterday or the previous class. This one is cost of capital. It's not very clear. Cost of capital, you can say COC. I'm reminding you what we discussed in our yesterday's class. Yes, immediately you see that, then the cash flow is not the same as the profit. Thank you very much. And so you already know that you have to bring the aspect of depreciation. We are saying that if the tax is not given, then depreciation rate is irrelevant. Even if you are given depreciation rate, it is irrelevant. But if the tax is given, then now you have to think of what Winfred is saying, that the cash flow is not the same as the profit, so you have to bring in the depreciation elements into this particular case. You have to think about the depreciation elements. So meaning that we need to calculate our cash flow from here. So what are we lacking? From the NPV that we have done in the previous class, we know that we can get our IO, that one we can use. We can use 3 years. Of course, it is going to be every year annuity. So we can use this PVFA, that is true, use PVFA. We have the scrap value. This is now the final amount that you're going to sell. If you use a gari at the end, meaning that that gari may depreciate, but kuna ile value too ya mwisho, the residue, is going to give you one-off money at the end. So the value of this amount, it is going to be realized at the end of 3 years. We sell the motor vehicle or the machine and get 80,000. We can get the net present value of this 80, equivalent of this today. Hii gari umenunua, ukapata pesa, umepata pesa, alafu kuna kapisi imebaki that you're going to sell at the end. Now that portion that you're going to sell, is going to generate you some money, which is a one-off thing. Hautakuwa ukiuza kila siku. The one-off at the end of 3 years, right? So you can get the net present value of this, then we bring. So when you're looking at the net present value, kama zile pesa zenye zimeingia, the money that we got, we'll have to use the NPV of the cash flows and the NPV of the cash that you're going to get at the end. The cash flow that you're going to get here every year, and then the last lump sum money that you're going to get. That makes the total amount that you're going to receive as a result of this machine. Is that true? Umenunua simu sahihi, hiyo simu inaleta pesa, hiyo pesa utahesabu. You'll be counting that money. But remember, at the end of the year, you again sell the same phone. Even if it's at a lower price, you shall have benefited. So how much benefit we have? The normal one that we have during the year, plus the last value that you're going to have at the end. And of course, if you buy the machine at 500,000, then you sell it at 80,000, then you can guess how much it has depreciated. You can know how much it has depreciated. That is 500 minus 8. And so from here, 500 minus 80, you can easily get the depreciation per year. You get the difference between this and this, then depreciate it within 3 years on a straight line. Then you can allocate every year between inaisha and how much, right? So this means that the question requires us now to calculate, required Roman 1, calculate the NPV of the project. You can just write that. Roman 1, calculate the NPV of the project. Roman 1, calculate the NPV of the project. The NPV of the project. Roman 2, carry out sensitivity analysis of the cost of the equity, of the equipment, sorry. Carry out sensitivity analysis of the cost of the equipment. Carry out sensitivity analysis of the cost of the equipment. Carry out sensitivity analysis of the cost of the equipment, comma, scrap value and sales. So we have the cost, sensitivity analysis of the cost, then scrap value and the sales. That is what they want. Right? Now, whenever we are doing sensitivity analysis, they are given at the first question, and the first question is, you get the NPV. We can easily get NPV, right? So let's look at how we can get NPV. Net present value. So we have everything. We can start by calculating the position because that is what we need. So here we can easily, you can say solution. Then we start with depreciation. Or you just write chini yake, depreciation. This one is a kind of once. Depreciation is equal to 500 minus 80 all over 3 years. How much is it? 500 minus 80 all over 3 years. How much is it? How much are we depreciating per year? How much per year? We have the cost, so 140,000. Nice. So we agreed that there is a way we can do NPV. When they give us the element of tax, we can get NPV. We start by getting the cash flow, and we know very well that the cash flow is going to be annuity. So that means that we can use the formula of PV. But that is only for the cash flow, and then we'll add now at the end, we'll add now the value for the item that was sold, the value of the item that was sold. We'll add so that we get the total benefit, right? Now, we need to bring the elements from the first place. We have balance, or we have profit before depreciation and tax, which is, have they given us profit before depreciation and tax in how much? This one, revenue minus cost. Those are what we have. So we have 600 minus 400, which is giving us 200,000, right? Now that is the profit before depreciation and tax. Less depreciation. So profit before depreciation and tax, you start with this, then you go to tax. So less depreciation, which is 140. You will have your, how many? 60, right? 60,000.
Excuse me.
Yes.
While you're calculating the profit, your 600,000, was it really revenue or it was meant to increase by 600, meaning there was a revenue and therefore 600, it was meant to, that revenue was meant to increase by 600, or what exactly did you read?
Yes, so this means that the revenue will always go, at the end of the day, revenue is zero. See, you know, when you're doing financial accounting or you're preparing financial reports, normally at the end of the year, the P&L items start from zero. Una clear, unaanza fresh. Zero. And that is why in audit we say you look at cutoff so that you only include what happened within the year. Now, for revenue, every year you start from zero, a clean plate. At the end of the year, it has increased from zero to a certain amount. Meaning that ulianza ikiwa haikuwa na kitu, but at the end of the day, ikasonga hadi 600. The following year, the same with that. So they have not given us what it was at the beginning of the year, and it is not always there. Because at the beginning of the year, we always start from zero revenue. Then from there, it now move. So you say that revenue has gone up by 600 from zero. The following year, you start again fresh, it goes up again. So That is what they mean when they are saying there will always be an incremental revenue of this and this. So you look at the differences between the increase in revenue and the increase in cost. That is what actually we are having in the end for that particular year. And even assume that the year before this, prior year before this, let's say that you are having, at the end of that year, you are having revenue, even if it is 50,000. Then in this year, in the first year, it increased by 600. The same happens with cost. Maybe we had 40. In that year alone, when we opened it was 40. In that year, it increases by 400. What we are supposed to include as part of our P&L items, our revenue and expenses for this year one, are the only transactions of the revenues that were generated by that in that year. The previous ones we don't include because they were not related to our year of accounting. So the same case here. Even if you had some in the previous year, in the first year, the only one that we got is that increment. That is what belongs to that year. So ignore about what happened in the past. Even if they could have given you, that one does not relate to the year that you are confirming. And that is why in audit or in accounting, you only include expenses and revenue for the year. When you get the profit at the end of the year, you transfer that profit to P&L item, to the balance sheet item as reserves, right? Once you transfer it there, you have zero to start again. You again start again, right? So it keeps on moving like that. So that is what we're going to use for this case. So that is less depreciation. Then after this, what is next? We now tax the profit before tax. You tax. So taxation. Taxation, 30%. So 30% of this profit before tax is the profit before tax. When you tax it, it is 18,000, right? Then you have there profit after tax, which you call PAT. Then is 42, right? Now on it, add back depreciation. We agreed that depreciation is just imaginary. It is not actual money. So you add back depreciation on this. So add back which is 140. So that you have 182. This is now what we call cash flow. So that is now the cash flow that we have. It is not the same as profit after tax. It is profit after tax plus depreciation. That is what we call tax cash flow. So this basically means there is something that is called tax shield. There is amount that is called tax shield. This particular amount of depreciation has been protected. It has been shielded from taxation. So it is the one that we call tax shield. It has escaped tax. So we have saved some amount by not taxing that amount, that amount. We have saved certain amount. There is amount that we have saved. If we could have taxed it in a way, but we have saved it, right? 30% of this we have saved was supposed to be taxed. Remember, the whole 140 was our money, but we have removed 140 before we tax it because we are going to tax it and 30% will go pamoja with the other 30% of the tax, the profit before tax. So the tax shield there is 30% of this. That is what we have saved. We have saved a 30% of this, a tax on this. So when we'll be using the word tax shield, you should be able to understand this amount that we have saved from depreciation, this amount of tax that we have saved, right? Now, I hope that you guys have written up to here so that we can get our NPV now because we have cash flow. This amount is going to happen regularly every year, so we can get our cash flow NPV. So the NPV is equal to, what is it? It is the cash flow times PV for how many years? 3 years, 10%. So it is PV for of 10% for 3 years. But that is not all. There is salvage amount. So this one is just the, we are getting the NPV. This one is just the present value for the cash flow only. What about the final amount that we sold the machine at? So that one is one of, it was not, we are not selling every year. So we add it plus that final amount, which is the disposed amount, which is 80,000 times PV. That is present value of interest factor of the same period, which is now 10%, again 3 years. And because we are talking about net, we have to minus the initial cost of capital, which is 500,000. Otherwise, if we don't minus 500,000, it is just present value that we are getting. But if you want to get net present value, we have to minus that so that it is called net. I'll repeat again because I know the board is not very clear. So net present value is the total cash flows discounted to a present value. All the cash flows in future, the future cash flows discounted back to the present value minus the initial investment. Because the initial investment is money that has been released now. So you don't discount this. Hii tumetoa sahi, easy is the future. So we bring them back from the future to date, and then now we take them, the equivalent amount, we minus what we are investing. That is when we can know whether this investment is worthwhile. So you don't discount the 500. Now from here, I'll wrap this. Allow me to wrap this one. From here, we can easily get our NPV, and we say that the NPV is now too much. Hiyo kalamu sasa imecheza sana. Let me try another one. That the NPV is equal to 182 times. What is the PV of this? PV, we say that the formula is 1 minus, in bracket 1 plus R negative N all over. In fact, let me just replace them so that we have 0.1 in bracket negative 3 because it is the same amount. Then all this under, all this, not just the one in the bracket, the whole of it, 0.1. That is the rate. Now, this one is equity ordinary. Equity ordinary, because for a normal transaction, you do the business, then you get the total amount at the end of the year. That is when you estimate how much you lost and how much you gained. What I mean by loss is what you spent. So that is ordinary. Unless the examiner tells you that it was at the beginning of the year, that is when you use the annuity due. But this one is ordinary annuity. Annuity due is the one that you add here times, you put times R plus 1 plus R. That is the only difference. So now from here, we have 80,000 times 1 plus R raised to power negative N, right? Minus 500,000. This one is a one-off thing. So this one is PV, and this is the formula. It's 1 plus R minus negative N. Are we together there? And it is going to be done at the 3rd year, meaning that this value will depreciate on the 1st year, the 2nd year, the 3rd year is when you're going to get it. So you get the equivalent value of this in the 3rd year. This one is 80,000. Need to have it clearly written, 80,000. 80,000. Now let's come here. It's 182 times. What is the value here? Can somebody get me? Somebody to calculate for me that one. It's 2.4868. Somebody to confirm the amount to be sure. It is 2.4869. So we have 2.4869 plus, somebody to calculate this one, replace it with 10 so that we have here 0.1 to negative 3. What is the value of that? Hizi ni pesa zote tumepata. So this one will be like that. Then this one will be this times. The second one is how much? What is the value of the second one? Hii ni ngapi? Should be 0 point something. Bana calculate hiyo kitu bana wewe. Hii calculate. 7513. So it is 0.7513 plus or minus now, minus 500. Give me this one times this times this. Natoa ngapi? The first one, this times this. Fanya nakala. Fanya haraka. Nataka kuona kila mtu anafanya hesabu hapa. Nataka kuona kama kila mtu anafanya hesabu. This one is 452 615 615.8 plus 60 104 minus 500. So the final value ni ngapi? Hii yote ifanye inatoa ngapi? So thank you very much. Is it that one? 12 or 19? Hebu ongeza hadi vizuri tena. Mimi napata 19. Somebody to confirm. Should be 20. Somebody say 20. So we are around there. Okay. That doesn't matter. The thing is, I always say that once you have received this is the NPV. What is the next thing that you are supposed to do? Kama unakumbuka vizuri, nilisema ukifika tu hapo, what are you not supposed to forget? Accept. Yes. Accept the project or reject. That is advice. So in this one, we accept, right? We accept the project because it is positive. Any NPV that is positive, even if it is positive 0 point something, you accept that project. Now, let's look at method number 2, which does not go through all this. This one I hope that you copy. So let's just go to method 2. So method 2, how do we normally reach at the cash flow? How did we get the cash flow? What to get this one? So they are saying that cash flow is the profit before depreciation and tax. When you have that profit before depreciation and tax minus, we want to remove the tax. So meaning that the whole profit, the way it is, without removing depreciation, we want to tax it. So the tax is how much? 1 minus T, right? That is the amount that we are remaining. Ukitoa tax, unabaki na 1 minus T, which is 70%. Si ukweli? Si tax is 30%, which is the same as 0.3. So meaning that what you're supposed to remain with is 0.7. So our value is 0.7 of this. That's what we are now calling cash flow. But then there is amount that imeenda na hii. Kuna kavalue imeenda na hii kama tax. That amount that we should have saved when we were not depreciating, when we are not taxing depreciation. We have not saved it here. I'm coming again. In this amount, this is the amount that we have received, kijumla, the total. On this amount, if we can tax it directly, ile balance itabaki ni 0.7 because 0.3 is the tax. So we are only supposed to remain with 0.7. Now that means that we took the whole amount, we taxed it without removing depreciation. So there is a portion of depreciation that we are supposed to save from tax. Hatujai save. So that means that it has also been taxed. So what are we supposed to do? We need to bring it back. That is called tax share. The amount of depreciation was this one. 30% of this is the tax share, is the amount that we are supposed to have saved. Lakini hatujai save because we tax everything pamoja. Now that is tax share. So that is why we are saying, now on this, once you've done that mistake by taxing this one as a whole, remember to bring the portion that you are supposed to save. You are supposed to still save it back. So bring back, add depreciation times the amount of tax on it. The amount that you are supposed to save was 30% of depreciation. We have not said it here. So add it back. So that is called depreciation tax shield. Depreciation tax shield. It is called DT. Add it back so that you can save it. I hope that you understand that as a finance person, depreciation is not real money. It is just imaginary. You are not supposed to subtract it for finance decision making. But for accounting, it is okay. But finance, you cannot go to your account and then remove a portion of your income. Unasema hii ni depreciation, unaipeleka wapi? Bado itakuwa. But because we want to take advantage of what accountants are doing, we want to reduce the taxable amount. We always say that, oh, sisi pia tuko na depreciation, wacha tutoe. So that is why we are removing it here. But then, when the taxman has taken his portion, we know very well that we still have that money. We bring it back through back door. So the taxman has only gone with the net without depreciation being taxed. But in this case, we are saying that just in case you forgot to save that amount, you forgot to save the amount that was supposed to be taxed here by removing it so that you tax the balance, then bring it back. Meaning that the taxman is coming to tax everything. He has taken that portion here. Now, it only makes sense that you try to bring it back because you are supposed to save it anyway. So still go ahead and save it. So you bring it back, and so we call it tax shield. So this is how the formula looks like, and that is what you'll be using going forward when you are going to use sensitivity analysis. Now, let's come back to this one. Let's try. If it is going to give us the same answer that we had, this one. So let's take our profit before tax and depreciation, or before depreciation and tax is 200. So let's have 200 into 1 minus tax is 0.7, plus depreciation is 140 times tax is 0.3. We are supposed to add it back because tulichapa ikiwa pamoja hapa. So we add it back. Now this one is going to give you, this one times this is going to give you 140, I believe, plus this one times this, how much is that? 140 times 0.3. $42,000. Thank you. 42,000. Right? How much do you get in total there? When you add the two, 140 plus 42,000, you get 182. Is it what you got somewhere? We had 182 somewhere. Is it not cash flow? It is, right? So that tells us that you can still get cash flow without using this formula, but going through this one. Because the reasoning is the same. You do it manually, unaweka manually ni sawa. Kichapa yote, alafu rudishe, bado ni sawa. I know this one is challenging, but this is the most recommended because you use it. You need it somewhere. This one is good. But they might set a question that you have to use this. So keep this in mind. So now we know how to get the cash flow, and we have our cash flow there. Now let's do our sensitivity analysis. Let's use our sensitivity analysis. What does this mean? Profit before tax and depreciation. What does it mean? You remember how we got it? You remember That is nice. So what we did, we took revenue minus cost. That is what we call profit before depreciation and tax, right? So this means that then our cash flow is equal to revenue minus cost times our portion after tax, that is 1 minus T. Plus D plus T, right? Plus D plus T. Plus DT. So up to there, that is the cash flow. Now the rest are the same. The rest are the same. Because we say we have only that formula, that long formula means 182. It is the same as 182,000. Then now the rest are the same. So then we can write this formula like this. For NPV, we can say that NPV is equal to R minus C, bracket, 1 minus T, into bracket, plus D, T, right, times. So the all of this, the all of that, times PV of 10%, 3 years, plus PV 10%, 3 years, minus initial outlay. That is what we call NPV. The all of this is basically cash flow. This. Inakuwa ngumu ama mko sawa? Naona watu wameepa. Mr. R or Madam R ameepa. Imekuwa ngumu ama mko sawa? The rest are the same. Are we together? Hakuna mwenye anasema yes. Are we together? Jiri tuko sure? Are you sure? Hiyo PV umeongeza juu ya scrap value. Ndio shida. Yes, nimeongeza juu ya scrap value. That is true. So then you are supposed to have the scrap value, which is 80%, 80,000 times PV. You are right. So that is that. That is very okay. So we have 80,000 times PV because of scrap value. All of this is cash flow, and then the PV part. Then we minus. Si bado iko sawa? Winnie, hujaniambia kama uko sawa. Samuel, how is it? Nataka nisonge with confidence. Winnie is okay. What about you, Abdi? Imeleta kelele? Inaleta kelele? Mko na tashwishi? So now that you guys are telling me that you're okay up to there, I'm very happy because this thing is very easy now. Now let's come. The reason why we're using this formula. So R, you say that you left kidogo. Ulitoka kidogo. Where do I repeat? I know you left when I was here. The only thing that I've added is B. So what we are saying is that from the formula that we have had, we say that profit before tax, which was this one, I know you are there. We got it by taking revenue minus cost. That is what we call profit before tax. Scrap value should be there. In the formula, scrap value should be there. This scrap value is just the same as cash flow. This one hii ni kama hii. So unaweza andika scrap value ama unaweza weka ile nimeweka hivi. Right? See, tulikuwa na cash flow. All this basically cash flow. So that the cash flow is what we actually multiply with the discounting factor of annuity, which is called PV. The same way, the scrap value we are supposed to multiply with the PV. So there's no change. This is what basically we had here. The scrap value, this one. And then this one, your T. So the only difference is what we have from here. The whole of that story. Because we agreed that there's a better way of getting it here. So it was actually 182,000. Down here. It's actually down there. So there's nothing that I've done. Sijakosa at all. So R, Madam or Mr. R, we are saying that what we have just replaced is this one that we will replace with this. Hii naye uliona 1 minus tax. That is the amount that you should remain with as your income when you taxed it. That is this one. And then this one, you know, equal half. So there's nothing new. Now, let's now break these things into perspective and try if you're going to get the same answer, all right? So we have NPV given us 600, which is the revenue, minus 400, that is a cost, into bracket. This one is 0.7 plus this one. This one is this times this. We got it, right? It was 140 times 30%, it is 0.3. Then the whole of it, the whole of this, you multiply with PVFA. And PVFA we got, it was this. Right? So that one is done. Then minus not minus but plus the scrap value, which is 80,000 times interest factor of 80 that one minus 500. When you do that, you're going to get the same amount that we got, 719.8. That is basically what we did, and that is what you're going to get if you try it. Because this one minus this one is 200. 200 times this is 140. That is what we have here, 140. The other one is 42. We're going to have it here, right? Then minus. So this one is 42. Yeah. So it is 182, right? It is 182. 182 is there. Is this amount now? is that amount. Are we okay? Yes, it's going to be 182. 182 times, when you add all that, you're going to get 182, this one. Then you now multiply with the PVFA, and then there's also multiply this minus 700. So that is 182, multiply with this, then here 80 minus 500. You're going to get the same thing. Now, here is hesabu utajaribu, but copy that. We'll just go through it again, but that is what it is. So now, from here, remember what the question wanted. Why are we using this formula? Because the question was asking in Roman number 2. We have got an NPV, which is fine. This is the NPV, and we can advise, accept. But Roman number 2, the question was asking, carry out sensitivity analysis on the cost of the equipment. So we need to have used a formula that can separate the cost of equipment so that we can be able to see it. Equate visible. So in this case, the cost of equipment is 500. We'll now replace that 500 with a certain value like X. The second one was talking about sensitivity analysis on the scrap value. That is 80. We'll now replace 80 to be X, and then we see the change that will happen. Then the last one was sales revenue. We just come and replace now the revenue with X. And that is why we had to separate revenue so that we can clearly see what represents the revenue and what represents the cost. And here, this is how we could have seen it. If we use this one directly, you've actually combined them already. So we needed to separate them so that we have revenue as R and cost as C. And that is why we were breaking it like that. So that is why we had to use this formula so that we can be able to break them like that. So now with this formula, you can easily get it. But even the previous one that I used, the one that we used initially, if you could separate that 180, 182, you could separate them. That is okay. But remember, it was coming together. 182 was coming together. You could not easily get cost because 182 that we're using as cash flow in that other formula was together with this one. So you could not say that 182 is revenue or 182 is cost. But with this formula, you can identify them clearly where they are. Now, we shall do sensitivity analysis now. This was a question that was set in 2019. They gave that question to you guys in 2019. Question number 1, B and C. And it was a good marks. Question number 1, B and C, and it was a good marks. We shall see. We shall see. We shall do it as the second example when we have time. So let's do sensitivity analysis. What did we say sensitivity analysis is? We are looking at the impact on net present value as a result of a change of one of the variables. One of the variables here is the initial cost of investment. The second variable is the revenue, and of course, even cost. They can tell you next time get cost. In this case, we have only the cost of equipment, not the cost of running the business. That is also another variable. So let's look at the sensitivity analysis of equipment. So sensitivity analysis of cost of equipment. Sensitivity analysis of the cost of equipment. So let the cost of equipment be X. let the cost of equipment be X. So that we can reframe the formula and say that our new NPV is equal to 600,000 minus 400,000. That is here. Times 0.7 plus this times this. Those are not changing. So we can just have them the way they are. That is 140 times 0.3 plus, now the whole thing, times 2.4869 plus 80 times 513 minus X. What we are replacing is this one. That is the only thing that we want to replace. So what does this mean? When you are using this particular formula of break-even point, you assume that the NPV is 0. So that means that all this we are going to calculate will be equal to 0. I'm not sure if you are going to get the formula, but we're going to say that NPV is equal to this one, which is equal to 0, because we are saying we are using break-even point, and at the break-even point, the NPV is 0, because it is assumed that the profit is 0. The cost is equal to revenue. So at that moment, all these will be equal to 0, because NPV is equal to all that story, and all that story is equal to 0. So basically, NPV and 0 are the same. Now, NPV is equal to if the NPV is equal to 0, then we can now say that 0 is equal to all that story, right? Can somebody add for me this? Tunapata ngapi? Hii tukifanya hadi hapa tunapata ngapi? From what you had initially. When you do all this, we are having something like 512.718, right? Is it 718? 98 minus 500. It was minus 500. We took apart a total. So minus X. So then this means, I'll repeat again, that NPV using break-even point is equal to 0. So it means that NPV is equal to this figure, which is equal to 0. So even if we remove NPV, we are basically saying that this figure, yote, is equal to 0. And that is what is here. So 0 is equal to that figure. Then this means that the X is equal to X is equal to 512.7198. And X was the cost of equipment. So new cost of equipment when NPV is 0 is going to be 512. That is the new cost of equipment. We have just replaced. We are saying that we want to see if NPV is 0, what will be the new cost of equipment? Using break-even point, NPV should be 0. So we are told to use cost of equipment in the sensitivity analysis. That is the first one. So if the NPV is 0 as required, because break-even point requires NPV to be 0. If it is 0, what will be that cost of equipment? It will be this. Now this one will be the new cost of equipment. So that means that our sensitivity analysis, you can say that sensitivity analysis or percentage change, which is adverse because the cost has gone up. Initially it was 500, but it has gone up now. Someone is saying that where did I get 512? Is there anybody who can see where I'm getting 512? In fact, it's not even 512. It is 512.7198. Is there anybody who can see where I got it? Is there anybody who can see where I got it? So someone, the question was asking, we did our first NPV and we were able to get the NPV. The NPV was 12.7198. That is the NPV that you have in your book. Is that true? What do you have in your book as NPV?
As NPV, the first one you had was 12,720.
Sasa kukula kwa hii nyumba jameni. Sasa mbona mmesahau kukula juu hakuna watu.
So the first NPV was okay, so just have it like that, no problem. Let's just have it as 12. No problem. So is it okay now? Is it okay now? Hapo sasa tuko sawa? Tuko sawa? Kila mtu ako sawa sasa? Winfred, are you okay? Judith is okay. Caleb, are you okay? Sawa. Aya. That is fine. So what we are saying is, the first one, the cost of investment was 500,000. Right now, when NPV is 0, the cost of investment is 512. That means that it has gone up, right? And that is adverse. So we have the percentage of adverse change is equal to the percentage of adverse change is equal to new minus all over all, which is the same as 512. Let me just say that 512.719.8 all over 500,000 minus 500,000. That's what we have. What is the answer now? 512.719.8 minus 500 all over 500. What is the answer? Mwalimu, I thought I understood this. NPV was 12. As this is confusing. No, it should not. That 5, remember you got NPV 12. How did you get 12? You took the total of this, which was coming to be 512,919 and then 719 minus 500, you ukapata NPV, which is 12. But we are saying that in sensitivity analysis, when you're using break-even point, you assume, when you're doing sensitivity analysis, when using break-even point, you assume that the NPV is equal to 0. The first one, I agree, it was not equal to 0. It was equal to 12. In the second circumstances, we are doing question number 2 now. Question number 2 is asking, carry out sensitivity analysis. The first one was okay, 12. That one was done. The second one, carry out sensitivity analysis, on these cases. The first one is on the cost of the equipment. That is the first one. So we are working with the cost of equipment. So when you are doing that, assume that now we don't know the cost of equipment, but NPV is 0. We want to know what is the new cost of equipment when we are using break-even point on sensitivity. Break-even point requires you to have NPV as 0. So we have 0 equal to all that story that we were having and X, because X is now the cost that we're looking for, which is equal to this one. So this one, 0 is equal to this minus X. Therefore, X is equal to 519. This is now the new value. So meaning that when NPV is 0, then the cost of equipment should be 12 or 512. Right? And this makes sense because if you check this one, the whole of this, you minus 500, you'll get 12 that we were having before. So this one is okay, right? So you get the value there to be 20. It is 2.5, yeah? 2.54%. Can we now replace one item here? I hope that you've written 2.54%. Let's now replace one item. The next one, the one that's to do sensitivity analysis on the scrap value. So we are going to do away with the scrap value. The scrap value is given wapi, this one. Hii ndio sasa itakuwa X. Na usichoke, hii ndio sasa itakuwa X. The rest remains the same. So then this means that we have minus 500, we retain it the way it was. 500 was the cost of capital. Other factors remains constant. This one changes to X. Using the same formula. Tumeelewana? This one is the scrap value. That is now what is changing to X. The other ones remain. So all that is equal to 0 because we are saying that when you are using break-even point, NPV is equal to 0. So if NPV is equal to 0, then all that is equal to 0. So can we do calculation again? Those who are able to calculate, tulipata ni ngapi? Toka hapa ikienda hivi, except this, we can easily get, right? We can easily get that. So what is the first value? This one. This adding up. Before we add X, this one, X times this, what is the value? So this one, we can have NPV is equal to this minus this 200 0 times 7, which is 140 actually. So I just have 140. This times this, we got 42. Times all these times 2.4869 plus 0.7513x. Sasa x iko hapa, so multiply 3x minus 500. So 500, when it crosses equal sign, it turns positive. So this one is equal to 500. Ndio. Tumeona hapo. So it crosses, it becomes 500. You're saying that the other one, when you calculate, it becomes 4. That is the first one. Fine. So tuko pamoja hapa. I hope tumeona. Hii ni negative 500. When it crosses the equal sign, it becomes positive. So then we have what you're giving us there, which is 42. So NPV, in fact, now we can just say that 42. No, 45, sorry. 45 to 615.8 plus 0.7513x is equal to 500,000. Up to there, are we okay? Sitaki mtu apotee. Tumeshika hadi hapo? Tumeelewa hadi hapo? Winfred is giving me the answer already. But the question is, are we okay up to there? Kabla tusonge mbele. So Judy is okay up to there. Amefuatilia. What about Sam, Abdi, Nelson? Nelson hajaongea. Amelog in atakatoroka, sio? Huh? Only Judy is okay. Wilfred pia anafuatilia, inaona amecontribute. Nelson and Abdi, Caleb. Abdi is okay. So this means that we can easily take this one on the other side here. So that we say that 500 minus is the pen that is failing me, but I hope to get one so that we can finish. This anadanganya ama ako serious. Wacha tujaribu. So 500 minus 45, this one, in 500 minus 45 to 61.8 is equal to 0.7513x. Again, you need mathematicians. When you subtract this and this, you get, is that what you're getting? Is that, no, yes, can somebody get me this figure now? This minus this. Someone to get me that figure. 500 minus this. I hope hamjapotea. Ni kama hii ndio nimepeleka the other side. So mathematically it is still okay, right? So what do we have there? Thank you, Nelson. At least you are not far. No, you're giving me different figures. It is 47,384.2. 47,387.2. Huh? They're different. 384 or 384.2. So we are having 47,384.2 is equal to 0.5 x. Right? So our x is equal to 47,384.2 divided by 0.7513, which is equal to what? What is the value of x? Find the value of x. Let me unmute you. Go ahead. Go ahead and ask. Please go ahead.
No, it's okay. It's okay. I think I've seen where I'd gone wrong.
You're okay. So you're saying that the figure is at 60. 3069.2, right? Now, are you able to do sensitivity analysis there? Now, this is the new X. So you go to the value that you're having. So the sensitivity analysis, that one was 80, right? It was 80. Was it 80 or something? Yeah, it was 80. So you are saying that the new value, or is it adverse or it is positive? It is positive, right? Because now we have 60. We have 60. 3069.2 minus 80 all over 80 times 100%. So this one is it is not adverse, it is a positive change. It is a positive change, right? So you can say that is the sensitivity analysis. You ignore the negative sign. We agreed. We ignore the negative side. Can we now replace X here? Other things remain constant. E, replace with this one, X. Then you solve, we see what you can do for revenue. Do sensitivity analysis for revenue, then share on WhatsApp group in our next class, or even tomorrow we see what the answers that you're getting are. It's okay?
Hello?
Yes.
Yes. So when we go back to that question, the value of X, I'm still trying to get the value of X. Hapo, 42,000 times 2 point, hapo juu. When NPV is equals to 140 plus hapo juu, there. So 140 plus 42,000 times 2.5, I mean 2.45, yes. So hiyo si unafaa kumultiply by 42k.
So you add this first. You add this first, then you get the answer. Remember, E142 was 200 times 0.7. That's 140. Yes. Plus this one is 42. So when you add this one, it gives you 182. So you get 182 times this. Plus this one is 0.7513x. So this one you cannot work. So when you have 182,000 times this, that is when we are getting around some figure like this, 452,615. Now, because we have 500 here, which was negative, right? We now bring it the other side. It becomes positive. This one was equal to 0, remember? Because NPV should be 0. So this all these were equal to 0. So we cross 500 crosses the other side. So then when you come here, it's now 500, which is positive, minus this one crosses, so that we remain with this one as positive on this other side. Hapo sasa iko sawa?
Yes.
Now, the second one, or the last one, you need now to do sensitivity analysis for the same ones. This one is 0, but now here we return the 80 because the other factors remain constant. We only have this one, X. because we are told revenue. So let's get the value, new value of revenue. Can we do that? Hebu tuendelee tuone. So this one will mean that we're going to have this times this. That is NPV is going to be this times this. That is 0.7x. This one is going to be 280, right? 1,000. Then plus this one 42,000 into bracket times 2.4869, right? Plus 80 times this. Inakuja ngapi? This one times 80 times 80 times 0.713. That is 60. 104. Right. So then this one is plus. No, it is minus. Minus because of this. So all that is up to here, minus 500. So minus 500 is equal to 0. Minus 500 is equal to 0. Then now we have this one is going to be 0.7 times 7. 2.4869 times 0.7. So this one is going to be 1.7408 x minus this times this. No, this one should not be there. So E42 no, it is there, right?
No, it's not part of it.
It is. Remember, this one was the tax shield, so it is equal from that. So it's 42, 00 times all that times 2.4869. So it is there. So this one is equal to this one has this 280 times 2.4869. That is 696,332. Then here plus 42. 42 times 2.4869. That is 104,489.8 plus 60.04 minus 500 is equal to 0. Okay, so somebody to assist us now with the calc. You add this minus that. So we have there 104,449.8 minus 69,632 plus 60 minus 500. So this one is equal to 1.7 . What answer are you getting? Nani amepata anything? Haya, hadi hapo. This is one. That is 1. Is also 1. So it is 1 million divided by 1.7. So the answer is 5. Imeisha kabisa. So it is 5, 9, 592, 703.5. So yes, that is okay. That is correct. So what we are trying to say here is that the revenue has gone down. Maybe it was 600, but now it is 592. So it has gone down. So that is adverse, and you can get that percentage. The percentage change is now adverse change. Percentage adverse change. You can say that it's 592, 703.5 minus 600,000, all over 600,000. Then you get it, ignore the negative sign because you have said it's adverse. If it is positive, fine. But still you not ignore the positive sign. So it should be, what percentage are you getting? Times 100, eh? Multiply, you got 100 times 100. It's 1.21, about 22%. 1.22%. %. Yes, you can round off. So tumeona vile tumefanya. Go and go through it again, revise so that you can remind yourself where you could be missing out. Let's meet next week. Next week on Sunday, we shall do scenario analysis. You can go and try question that was 2019 November. 2019 November question number 1, B and C. Is exactly what we have done here, where you are going to do sensitivity analysis of the project on sales, that is revenue, and also on cost. Will they tell you which type of sensitivity analysis? They might not tell you, but looking at what is given, you will automatically see. Like now, this one does not involve any percentage change. The other one was using percentage change. We say that sensitivity analysis or impact analysis uses a percentage change. When they will tell you there was a change like this. In this one, they are not telling you a change, but they are telling you which item to work with. So that will automatically tell you this one is not impact analysis. Otherwise, thank you very much. Sorry for hesabu ngumu. You have to find the value of x, the value of your x, but that is the value of your x, right? Yes. See you over the weekend. Yes, that is the value of your x. Okay. Any question? Any swali? Hakuna? Okay, so let me close the meeting.